Viewers at home, you are welcome to my presentation on valuation of business. In this presentation, I will be examining the free cash flows method of business valuation. If you are just coming across this YouTube channel for the first time, or if you have not subscribed in the past, please click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. So, what do we mean by free cash flows? A free cash flow is the amount of cash flows that is available to the business to use after all essential payments have been made. Free cash flows is the amount of cash flows that is available to the business to use after all essential payments have been made. Essential payments include tax payment and payment for capital expenditure. I've told you that free cash flows is the amount of cash flows that is available to the business to use after all essential payments have been made. Essential payments include number one, tax payment or payment for taxes. 2, payment for capital expenditure. Free cash flows is the amount of cash flows that the management are free to use. Amount of cash flows that the management are free to use in any way they want. That cash flows is said to be free cash flows. Amount of cash flows that the management are free to use in any way they want. So free cash flows can be categorized into two. Free cash flows can be divided into two. Number one, we have the free cash flows to the firm. Free cash flows to the firm. And number two is free cash flows to equity. I said free cash flow can be categorized into two. We have the free cash flows to the firm and free cash flows to the equity. Free cash flows to the firm. What do you mean by free cash flows to the firm? Free cash flows to firm or free cash flows to the firm is the cash flows generated by the firm as a whole, regardless of their source of finance. I repeat, free cash flows to the firm is the cash flows generated by the firm as a whole, regardless of their source of finance. Note the capital structure of the firm comprises the equity and debt. So the free cash flows to the firm is the free cash flow generated by the equity holders plus the free cash flow generated by the debt holder. Free cash flows to equity plus free cash flows to the debt holder. That will give you the free cash flows to the firm. I've told you that free cash flows to the firm comprises the free cash flows to equity and the free cash flows to the debt providers. Now, what do you mean by free cash flows to equity? Free cash flows to equity. This is the free cash flow to the firm. Free cash flows to the firm less interest payments and loans repayment. That is, after you have calculated the free cash flows to the firm, you are going to subtract the interest payments and loan repayments in order to get the free cash flows to the to equity. I repeat, to calculate the free cash flows to the firm to equity, the first thing is to calculate the free cash flows to the firm. Then you less interest payment, or you less interest paid, and then you also less the payment of loans or loans repaid. That will give you the free cash flows to equity. Now, I want to give you the format for calculating the free cash flows. Format for free cash flows. Free cash flows. Meaning that this format comprises the free cash flows to the firm and the free cash flow to equity. So, the first thing to start with is your EBIT. EBIT means earning before interest and tax. You start with your earnings before interest and tax. Then you also less tax on EBIT. You calculate your tax on your EBIT. Then you remove that. After this, you consider your non-cash items. Non-cash items. Those items that have been reported in the financial statement. That is before arriving at your EBIT. That does not involve the flows of cash. Examples of non-cash items are depreciation. You are going to add your depreciation back. Then loss from disposal of non-current assets. You add it. If you have amortization, amortization should be added. And if you have impairment loss should be added as well. Then if you have profit from disposal of non-current assets, the profit should be subtracted. These are the examples of non-cash items you add. After this, if you have proceeds from sales of non-current assets or proceeds from sales of PPE, you add it. The payment for purchase of non-current assets or payment for purchase of PPE, then you subtract this. Then if you have increase in working capital, increase in working capital should be subtracted. And if you have decrease in working capital, should be subtracted. This format is similar to the format of reporting the operating activities under the statement of cash flows. Operating activities in the statement of cash flows using indirect method. You know, you start with profit before tax. If you were preparing statement of cash flows, then you add your non-cash items. Then it's only that you will not consider the proceeds here, because this will be treated as investing activities, and these two will not be considered. Increase in working capital in the statement of cash flows is usually subtracted as well, while decrease is usually added. So it's not materially different from the operating activities under indirect method of preparing statement of cash flows. Now, after all these have been considered, then you arrive at the free cash flows to the firm. Free cash flows to the firm. Then you now less interest payment, if any. Then your loans repayment, if any, you subtract. By the time you subtract this, you arrive at the free cash flows to equity. Free cash flows to equity. This is the format for preparing statement of cash flows. But before I take a work example, I want to explain the increase or decrease in working capital and how you may arrive at the proceed or payment for purchase of non-current assets where this is not given. So, payment for purchase of non-current assets. So, to arrive at the payment, the first thing you do is to have or prepare the movement in non-current assets. Now, let's have movement. Working one, movement in PPE. You start with the opening balance. Opening balance. You may be provided with the opening and the closing statement of financial position. The balance in your opening statement of financial position is your opening balance. So what are those things that will bring about changes in PPE? Number one, you may have depreciation. Where there is depreciation, PPE will reduce. So you subtract your depreciation. Now, there may be revaluation of PPE during the year. So, which may give rise to revaluation surplus. If there is revaluation surplus, so you add it. That means PPE will increase where it is revalued upwards. Revaluation deficit. PPE will reduce where it is revalued downwards. And if you have any impairment loss, PPE will as well reduce. Upon this adjustment, you have this as your total. You now compare with the closing balance. Closing balance. So, if your closing balance is greater than this, that means there is acquisition. Acquisition, that is purchase of PPE, acquisition, which will be the carry amount. Acquisition stroke disposal. Acquisition will be negative. That is, where this exceeds this, you have minus. That is acquisition. But where this is more than this, that means there is a disposal. The carry amount of the PPE disposed will be arrived at using this format. Then, to calculate the proceed from disposal down where it is not given. Proceeds from disposal of PPE. you have the carrying amount of PPE disposed, carrying amount of PPE disposed as calculated here. Then if it is sold at a loss, the loss may be given. Loss on disposal. The loss on disposal should be subtracted. But if profit is given, profit from disposal will be added to arrive at the proceed. Proceed from disposal of PPE. Now, the next important working is movement in working capital. No, I've told you that increase in working capital or decrease in working capital will equally be considered. So we have increase. Remember, I've told you that increase will be subtracted. Stroke decrease in working capital. Working capital is current asset less current liabilities. You may have increase in inventories, trade receivables, prepaid expenses, trade payables, which is liability, accrued expenses. So you have your working capital. You compare your opening balance with the closing balance to know if there is an increase or decrease. So the same thing you do to the opening balance, you do it to the closing. Then you now compare the two balances to know if there is an increase or decrease in working capital. But certain items will be excluded from current assets and current liabilities. Those items to be excluded when you are calculating the increase or decrease in working capital include interest paid, since it's from interest is paid to the providers of loans. Interest paid will be excluded. Cash or cash equivalent will be excluded, such as cash in hand, cash at bank overdraft. All those items should be excluded. So these are some of the items that will not be considered when you are calculating the increase or decrease in your working capital. Now I want to take a work example. Example: Shasen Co. is considering making a bid for Butler Co., a rival company. The following information should be used to value Butler Co. All amount in $1 million. Revenue $285.1. Cost of sales $120.9 million. Gross profit $164.2 million. Operating expenses including depreciation of $12.3 million, and that amounted to $66.9 million. Profit from operations of $97.3 million. Finance cost of $10 million. Profit before tax of $87.3 million. We have taxation of 21.6. Profit after tax of 65.7. Other information. Selling prices are expected to rise at 3% per annum for the next 3 years and then stay constant thereafter. sales volume are expected to rise at 5% per annum for the next 3 years and then stay constant thereafter. Assume that cost of sales is a completely variable cost and that other operating expenses including depreciation are expected to stay constant. Butler Co. invested $15 million in non-current assets and $2 million in working capital last year. These annual amounts are expected to stay constant in future. Butler Co. financing costs are expected to stay constant each year in the future. The marginal rate of tax is 28% payable in the year in which the liability arises. Assume that book depreciation equals tax depreciation. Butler Co. has 500 million shares in issue. The work of Butler Co. is 9% and its cost of equity is 12% required. Calculate the value of the equity in Butler Co. in total and per share by forecasting future free cash flows to equity. This question is obtained from ACCA study test Advanced Financial Management by Kaplan Company. Now let's have the solution to the question. So valuation of equity of Butler Co. Let's have years. Year 1, year 2, year 3, let me also have 3. Amount in million. So back to the question. We were told that selling prices are expected to rise at 3% for the next 3 years and then stay constant thereafter. Sales volume are expected to rise at 5% per annum for the next 3 years and then stay constant thereafter. That means both revenue and sales volume will increase by 3% and 5% respectively. 3% increase in sales revenue. Increase means you add it to 100. If you add 3 to 100, you have 103. 103%, if you divide it by 100, if you convert it to decimal, it will be 1.03. Same also, this will give you 1.05. So that means your sales now, to calculate your sales, you multiply it by 1.03 to get the increase in selling price times 1.05 in order to get the increase in sales volume. And the initial sales, the sales for the current year is 285.1. 285.1 times 1.03 times 1.05. That gives us 308.3. So you also multiply times 1.03 times 1.05. That gives us 333.5. Also multiply this by the same amount times 1.03 times 1.05. You also have 360.6. Year 3. Now, after sales, you have cost of sales. Remember, since you were told that cost of sales, assume that cost of sales is completely variable cost, and that all other operating expenses including depreciation are expected to stay constant. Cost of sales, if it is variable cost, that means it will vary per sales volume. Therefore, the 5% increase in sales volume will also affect our cost of sales. So cost of sales times 1.05. So it will not be affected by 3% increase, because that 3% affects the selling price. It is 1.05 that affects the sales volume that we have a bearing on our cost of sales. And our initial cost of sales is 120.9. 120.9 times 1.05. If you multiply it by 1.05, it gives us 126.9 times 1.05, that gives us 133.3 times 1.05, that gives us 139.9. If you approximate it, it will be 140.0. That is for year 1, 2, and 3 respectively. We've done with the cost of sales. If you subtract cost of sales, you get gross profit. Then you have operating expenses. Operating expenses, including 12.3 million depreciation. Now let's see the note we have as regards that. Operating expenses including depreciation. We were told that assume that cost of sales is a completely variable cost, and that other operating expenses including depreciation are expected to stay constant. Either should stay constant, and we are having 66.9. That means our operating expenses will remain at that. Operating expenses, since it will remain constant, then you have 66.9, 66.9, 66.9. Now we have finance cost of 10 million. Let's see if there's any notes on that. So the note, this one is talking about the investment. Now, yes, Butler Co's financing costs are expected to stay constant each year in the future. Since finance costs will stay constant, and we are given 10 million as our finance cost. So, and we were told that it will stay constant. So we have finance cost of 10 million each year. 10.0 each year, 10.0 each year. After finance cost, you have profit before tax. Then the next one is taxation. Now let's go through the other note. Assume that book depreciation equals tax depreciation. We know depreciation of 12.3 million has been included in operating expenses. Had it been the tax depreciation is different from book depreciation, you will have subtracted this 12.3 million from 66.9 million in order to get operating expenses. But since both are the same, that is why we still treated the whole 66.6 million. We are going to allow the whole 66.9 million as deduction. So now let's subtract in order to get profit before tax. Profit before tax. So we have 308.3 minus 126.9 minus 66.9 minus 10. We have 104.5. Then for this, year 2, 333.5 minus 133.3 minus 66.9 minus 10. That gives us 123.3. Then the last one, 360.6 minus 140 minus 66.9 minus 10. Then you have 143.7. Then you now calculate your taxation. And what is the tax rate? Back to the note. You were told that the marginal rate of tax is 28%, payable in the year in which the liability arises. If the marginal rate of tax is as given, so you calculate 28% of our profit before tax in order to get the tax payable. 28% of 143.7, that gives us 40.2. 40.2. 28% of 123.3, that gives us 34.5. 34.5. Then 28% of 104.5, that gives us 29.3. 29.3. The next item after this is non-cash item. The only non-cash item we have is depreciation. And you were told that depreciation is 12.3 million and it has been included in operating expenses. And since it remains constant each year, you are going to retain that 12.3 million for each of the years. 12.3 million. Depreciation is the only non-cash items we have. Back to the question. Now, after non-cash item, you were told that assume that the book depreciation equal to tax depreciation. That has been considered. Botlaco has 500 million shares in issue. That has been considered. Now, Botlaco invested 50 million in non-current assets and 2 million in working capital last year. These annual amounts are expected to stay constant in the future. The investment of 50 million in non-current assets and working capital, you were told it will remain constant in the future. So we have investment in non-current assets of 50 million each year. $50 million each year. Also, investment in working capital. Working capital of 2 million each year as well. So you now subtract we have 104.5 minus 29.3 plus 12.3 minus 15 minus 2 million. Then you have 70.5 million. In year one, 70.5 million. That is the free cash flows to equity. You have 70.5 million. That is the addition of all these items. Then year 2, you have 123.3 minus 34.5 plus 12.3 minus 15 minus 2. Year 2, you have 84.1 million. Year 2, the total is 84.1 million. That is the free cash flows to equity. Year 3, 143.7 minus 40.2 plus 12.3 minus 15 minus 2. Then you have 98.3 million. Year 3. Total is 98.8 million. Let me include year 3 for simplicity. Since back to the requirement, you have to calculate the value of equity in Butler Co. in total and per share by forecasting future free cash flows. The free cash flows have been forecasted. So we want to compute the value of equity. We want to compute the value of equity. Now, since you have computed the value of free cash flows to equity, you are going to discount the free cash flows to equity using the cost of equity. You are given the cost of equity to be 12%. I've told you that if it is free cash flows to the firm, you would have used the weighted average cost of capital of 9%. But since it is free cash flows to equity, then you use the cost of equity. Discount factor at 12%. For year 1, no, the discount factor 1 plus r raised to power minus n, where r is 12%. So we have 1.12 raised to power minus, so the number of years for year 1 now, so you have 1. For year 2 you put 2. For year 3 you put 3. So in that order. So 1.12 raised to power minus 1. Year 1 you have is 0.893. 0.893. In year 2, 1.12 raised to power minus 2. That gives us 0.797. In year 3, we have 1.12 raised to power minus 3. Then that gives us 0.712. You now discount it to get its present value. You discount it. What is the present value? Amount is still in $1 million. So 70.5 times 70.5 times 0.893. That gives us approximately 63.0 million. 63.0. Then 84.1 times 0.797. That gives us 67.0 million. Then in year 3, 98.8 times 0.712. That gives us 70.3. The 70.3 you got in year 3. Now back to the question. If you look at the cash flows you were given, you were told, if you look at the note 1, selling prices are expected to rise at 3% per annum for the next 3 years and then stay constant thereafter. That means after the 3 years, it will stay constant. That means the cash flows will remain till perpetuity. Since it will remain till perpetuity, that means from year 3 onwards, you are going to make use of a perpetual annuity. I've told you that for perpetual annuity, the present value is 1 over R, where R is the cost of capital. So, to get the cash flows for year 40 perpetuity, you are going to discount the present value of year 3 till perpetuity. Now what you have as the present value at the end of year 3 will be the present value at the beginning of year 4. So meaning that year 4 till perpetuity now will be 70.3 divided by R. R is 12%. 12%, 0.12. So the present value of that till perpetuity now will be 70.3 divided by 0.12. That gives us 585.8. What is now the total of everything? So the value of Butler Co now, value of equity, or let me say total value of equity of Butler Co will now be, if you sum it up, 63.0 plus 67 plus 70.3 plus 585.8. That gives us 786.1 million dollars. So that is the total value. And you were told that Butler Co has 500 million shares in issue. If Butler Co has 5 million, and you have to calculate the value of the equity in Butler Co in total, we have got the value in total and per share. To get the value per share now, you divide by number of shares of 500 million. Value of equity per share now will be 786.1 divided by 500 million. That gives us 1.6 $1.6 per share. That is the value of equity. So that is the end of this part of my video on free cash flows method of valuation. My next videos, further work examples will be considered. Thanks for watching ACCA.